I want to welcome everybody to today's webinar, and I want to thank Dallas Kerley, President of Benetrends, for giving us his time for this presentation. Dallas, I met Dallas several years ago. He's the president of Benetrends, and they do a lot of rollover business startups and have a lot of good ideas on how to make your retirement funds work for you. We like working with Dallas and sending some of our clients that their needs are better fit by Benetrends, and Dallas will talk to us today about those types of products and services that Benetrends provides. The first thing I want to do is, if you have any questions, we'll get to those at the end, but type them into the question box. And second thing is, CamaPlan doesn't recommend or endorse any products or services, as always in our in any of our presentations. So at this point, I'd like to turn it over to Dallas and wish him or thank him for being here today. Are you there, Dallas?
I'm here, Carl. Thank you.
Yeah, how's everything going over at Benetrends?
Everything's going fantastic. It's an exciting time. The economy's great. A lot of entrepreneurs are looking to start businesses, so it's a great time.
Hey, can you tell us a little bit about yourself and Benetrends before you get started on talking about the ROBs and the RAPs?
Sure, absolutely. I came to Benetrends kind of in an interesting way. I was working at an investment firm where we ran a large cap equity portfolio, and one of my clients was mentioning they were going to buy a business and they were going to utilize their IRA. And I said, well, you're going to have to pay taxes and penalties when you do that. And he goes, no, I don't have to. There's a strategy called ROBs that this firm Benetrends pioneered in 1983, and it allows me to invest in a business tax deferred and penalty free. So, coming from that industry where, we're told that you can't do that, I reached out to Benetrends founder, Len Fisher, and said, listen, I have a client who's, thinking about utilizing your firm. I've never heard of this. Can you tell me a little bit about it? And so he explained the process and some of the benefits and how it works. And we dove into some of the IRS code and confirmed that it was a legitimate process. And as he and I discussed, more and more going forward, he made me an offer I couldn't refuse, and it was an exciting field that I hadn't participated in before. And the rest, they say, is history. I've been here a little over 8 years now, and I've had a great time, particularly, meeting all the different entrepreneurs. We fund, approximately 12 to 1,300 new businesses a year. So you get to hear a lot of exciting stories.
No, I think that's great. And just so everybody knows, Len Fisher is not related to myself, Carl Fisher, although he does spell the name the same, I believe. But
that's true, he does, yes.
Yeah.
With the C, right?
Yep, Fischer. And I think he's out in California, right? And your offices are here in Pennsylvania?
Yes, we're in North Wales, Pennsylvania, and Len is bi-coastal, as we say. So he spends part of his time here, and when it gets too cold, he goes to California and for a few weeks at a time, and then comes back.
Great. All right. As we said earlier, if anybody has any questions, please put them in the questions box, and we'll get to them as soon as we can. Go ahead, Dallas. And again, thank you very much for your time, and I appreciate everything you're doing for us.
Great. Anxious to share our story and some of the strategies. So rollovers as a business startup is what the IRS and the Department of Labor call ROBs. Some people candidly have said, well, that's probably because you're robbing of their tax dollars, but eventually they're going to get tax dollars. There seems to be no way around that, but at least it's a more efficient way to start a business. So for for those of you that have not heard of this strategy, and it's really more popular than you may imagine, particularly in the franchise industry. Almost 20% of the franchises sold in the country utilize this as part of the funding strategy. It's been around more than 35 years. As I mentioned in the introduction, Len Fisher, our founder, was the original pioneer of this strategy, and subsequently in the following years, more and more firms have embraced this as a strategy. A few things to understand. It is not a self-directed IRA. One of the concerns people have when they confuse it about a self-directed IRA is that you can receive benefit from the investment. So you can take a salary, you can take profits, unlike a self-directed IRA. I'm going to dive into why was it created, how does it work, and some of the benefits. So if we look at a traditional IRA, and I'm going to use a $200,000 IRA as an example. When somebody's looking to start a business, many Americans have the bulk of their net worth or savings in an IRA, 401k, or other retirement plan due to the tax advantage nature of savings in those plans. But when they want to start a business and they look at pulling that money out, if they're under the age of 59 and a half, they're going to have to pay a 10% penalty. So in our example of a $200,000 IRA, they're going to pay a $20,000 penalty. And then they're going to pay state and federal income tax on the distribution. In our example, that's probably 30%. So their $200,000 savings is now only worth $120,000. So they lost $80,000 to taxes and penalties. And certainly, I think we can all agree starting a business is exciting enough without losing $80,000 before you open the door. So one of the strategies to avoid that is called ROBS, as I mentioned, and it's a pretty simple process. So the key to understanding how this works and why it works is to think of a large company. And I'm going to use Johnson & Johnson example. If you work for Johnson & Johnson and you participate in their 401k plan, typically you can invest in mutual funds from either Vanguard or Fidelity, but you can also buy the Johnson & Johnson stock. So the ROBS program has the same provisions as that Johnson & Johnson retirement plan. So the first step in the process is we create a corporation. It does have to be a C corporation. The C corporation is the only entity that has the provision to invest in employer securities. But Benetrends will incorporate you in the state of your residence or where you're going to start the business. Then that corporation that we've established for you will sponsor a new retirement plan. The retirement plan that's established will have the same provisions as Johnson & Johnson's plan, namely that you can invest in the employer or the corporate securities and stock. Once that plan is established, we're then going to take the funds from your existing IRA or previous employer's 401k, roll those funds over into the new plan. Because the funds are being rolled over from one qualified plan to another qualified plan, there are no taxes or penalties due at that time. Once the funds are in the retirement plan, then you would elect, instead of buying stock in Yahoo, Google, or eBay, or a mutual fund, you're going to invest those funds in your parent corporation. Your corporation now, from the sale of the stock to the retirement plan, has the funds in the corporate checking account to invest, buy, or start a new business. A simple four-step process. Once it has those funds in the business, let's look at some of the benefits. So it doesn't matter what your credit score is. So if you've had issues with a bankruptcy or poor credit, there's no credit check on this. This is a vehicle that allows you to utilize your savings. You can use pre-tax dollars to fund your business. So you don't have to pay the taxes first and then use the remainder to buy the business. You can avoid getting a loan depending on the size of your savings and your investment level. So you don't have to get an SBA loan. You can use full cash. When you do that, of course, your business cash flows sooner. And you reach break even or profitability quicker. You can also pay yourself a salary. So many times when people want to start a business, one of the concerns they have is, until my business is up and going, how am I going to pay the mortgage, keep food on the table, and smoke going up the chimney? Once that money is in the corporate checking account, it can be utilized for any legitimate business purposes, whether it's hiring employees, paying yourself a salary, or utilizing it for marketing. Recently, it's become more and more popular to utilize this as a cash injection for an SBA loan. So, for example, if you're looking at buying a business or starting a business that's a $500,000 business, and a bank is going to look for 30% cash injection, you may not have that $150,000 in your checking or savings account, but you may have it in a 401k or an IRA. So this will allow you to utilize those funds in your retirement plan as the cash injection for an SBA loan. So it's commonly known as a 401k rollover, but just about any retirement plan is eligible other than a Roth IRA. So as you can see in this slide, government plans, 457Bs, if you're a government employee in a military thrift savings plan, annuity plans, defined benefit plans. Again, Roth 401ks are eligible, but Roth IRAs do not qualify. So if you're thinking about starting or buying a business and you're looking at your savings and wondering whether you have enough, don't overlook the savings that you have in your retirement funds, whether it's an IRA, 401k, or other type of retirement plan. So this is one of the strategies, and probably the one that we're best known for at Benetrends. But we do have another strategy that allows you to leverage some of the provisions that are in that rollover plan for people who are going to use an SBA loan or pay cash for a business. So for our example client profile, we're going to use a client who's purchasing a business for $300,000. The thing to remember about this particular strategy, which we call our WRAP program, is that you don't need to utilize your retirement funds. In other words, you have enough cash and savings, or you're going to use the SBA loan. You don't need to utilize a significant portion of your retirement funds to purchase a business. So, having said that, there does need to be a small amount of retirement funds available. So let's look at what this strategy is, how it's structured, and what some of the advantages are, and where you might want to utilize this. So we're going to look at purchasing that $300,000 business, and in this example, we're going to assume that the client is going to pay cash. So in other words, the client has the $300,000 in savings. So we're going to structure this with the idea that as the business appreciates, we're going to want to have an exit strategy that mitigates any taxes on the sale of the business down the road. So we're going to structure it so that the client is going to take $25,000 from their retirement fund. So we're going to make the assumption that if somebody has $300,000 in cash, there's a pretty good chance that somewhere they have at least $25,000 in an IRA or 401k. We're going to take $25,000 of those retirement funds. We're going to roll it into a new 401k and then do an in-plan Roth conversion. So we're going to convert that $25,000 401k into a Roth 401k. At that point, there would be taxes applied to that, and in this example, you're probably looking at maybe $5,000 in taxes. Then the remaining $275,000 is going to come from the client's cash. The $275,000 personal investment is going to buy Class B shares in the corporation, and those Class B shares have specific provisions, namely that they're preferred shares with a cumulative dividend, and the preferred shares will be redeemable at par value, which we're going to say is the initial purchase price. The retirement plan, the Roth 401k, is going to buy $25,000 worth of common stock. So between the common stock purchase of $25,000 and the $275,000 of Class B shares, the company now has the $300,000 to start the business or to buy an existing business. So let's look at why you would want to set it up like this. So the whole purpose of this strategy is to minimize the taxes when you go to sell the business. So in our example, that $300,000 business, 10 years down the road, let's say it's sold for $1 million. So there's a $700,000 gain. So in our scenario, the Class B stock is redeemed at the par value, which is the $275,000 of the initial investment. So there's no gain. So if it's a preferred shareholder, which is the individual, they purchase the shares for $275,000. At the end, 10 years later, they get their $275,000 back. So there's no capital gain, and therefore no taxes are due. The remaining $725,000 from the sale of the stock is in our Rainmaker Advantage program, which is that Roth 401k. So assuming that the plan has been in place for 5 years and that the client is 59 and a half, they can withdraw that $725,000 should they choose to from the Roth 401k, and there are no taxes due at that time. So there's no state and federal income tax. So we've taken the $700,000 gain from the sale, and it's 100% tax-free. One of the other advantages of this strategy is if we take that Roth 401k and we roll that into a Roth IRA, if the Roth IRA has been in place for 5 years, there are no required minimum distributions at 70 and a half. So if you're looking to pass generational wealth, this is a strategy you can pass that on to your heirs, and there'll be no taxes due. Okay, let's look at a different strategy. So this is the same Rainmaker Advantage program, but we're going to look at it with an SBA purchase. So combining this strategy with a loan, an SBA purchase, has even greater advantages. So again, we're looking at that $300,000 business as the example. The bank is going to look for a 30% cash injection. So a $300,000 business, going to need $90,000 as the cash injection for the SBA loan. The client's going to make an $80,000 personal investment. They're going to roll over only $10,000 into the Roth 401k. So they're going to pay taxes on that $10,000. You may be looking at $2,500 to a $3,000 tax to do that conversion. Again, the Roth 401k is going to buy $10,000 in common stock. The personal investment of $80,000 is going to buy $80,000 of the Class B shares. Again, the preferred shares with a cumulative dividend that is redeemable at the initial purchase price. And the remaining $210,000 is going to come from the SBA loan. It's important to remember that the SBA loan, that $210,000, is a loan, it is debt, it does not get any stock. So the corporation has the $300,000, $10,000 of it came from the common stock, $80,000 from the personal investment in the preferred shares, and then the proceeds from the $210,000 SBA loan. Our corporation has the $300,000. Now let's look at the sales scenario here. So again, we're going to use 10 years down the road. The business is sold as a stock sale for $1 million. It's a $700,000 gain. The Class B preferred stock is redeemed again at preferred par value, $80,000. The individual gets the $80,000 back, no gain, and therefore no taxes due. The SBA loan is paid off in 10 years. There's a $920,000 remaining from the sale. That all goes into that Roth 401k. So now that the Roth 401k has a $910,000 profit, that's 100% tax-free. So this is a powerful vehicle if you believe that the business that you're buying or investing in is going to grow. It's also get asked often, well, what if the business doesn't grow? What if I bought a business for $300,000 and I strip all the profits out and 10 years down the road, it's still only worth $300,000. Well, if it's used in conjunction with an SBA loan, you've paid off that SBA loan. So if the business is sold for $300,000, that $210,000 SBA loan is paid off. That becomes equity, and that can go into the Roth 401k and still be pulled out tax-free. So in both of these scenarios, we're assuming a stock sale on the sale of the business in 10 years. Many people say, well, okay, listen, it's not going to be a stock sale. What if it's an asset sale? What does that look like? So let's look at an asset sale. So again, our $300,000 business sold for $1 million. There's a $700,000 gain. So on an asset sale, there's going to be corporate tax. So the corporation is going to pay a 21% tax on that $700,000 gain. That equals $147,000. The Class B stock, again, that preferred share, goes back to the individual for $275,000. No gain again. So after paying the taxes, there's still $578,000 that goes into that Roth 401k that, again, if it's been in place for 5 years and you're 59 and a half, you can pull out tax-free. So we're looking at, yes, you can pull it out tax-free, but one of the advantages not to overlook is that remaining, whether it's $720,000 or $920,000, depending on the scenario, or this $578, is in a tax-free growth vehicle, that Roth 401k. So it can continue to grow tax-free. So this has manifold advantages over a typical funding strategy. So again, this strategy leverages the same ERISA, which is Employer Retirement Income Security Act, provisions of a regular ROBS program or regular 401k or Roth 401k. It's an interesting way, depending on the scenario and your individual circumstances, to capitalize a business with the intention of having an exit strategy that provides significant tax advantages. So, it's not for everyone. It depends on your unique situation. But if you do fit the criteria, it's a powerful vehicle for building wealth and sheltering some of the taxes implicit in selling a business with a significant profit. Now, those are just two of the strategies. We do SBA loans in conjunction with these as well. But I'd like to open it up now to some questions.
Some of the questions that we have here is, what happens to the income? You talked about exit strategies. What happens to the income from that you make annually? Does that go back to the 401k or to the owners, or how does that work?
So you have the flexibility in doing that. That's a great question, Carl. So you can take the profits from the operation of the business and pay yourself a salary and bonus. So you can pull that out personally. You can pay dividends to the preferred shareholder, which you would be the individual in the case of the RAP program, or you can elect to pay dividends to the common shareholders, which would be the retirement plan. So depending on how you want to take care of the profits, you can strip the profits out so there's no profits in the C corporation, again, by taking the salary and dividend and bonus, or you can shelter more of that profits by shuttling it into the retirement plan. So working in conjunction with Benetrends and your accountant, we can take a look at your specific goals and determine the best way to handle that.
No, that's great. And I guess it would depend on where they are. Are you seeing more people looking at this since the corporate tax went down to the 21%?
Absolutely. It certainly made it more attractive. Prior to the tax change, the top corporate level was pretty close to 34%. But now that it's at 21%, it's much more attractive. And the other thing to keep in mind, when we talk about C corporations, many times people are concerned about the double taxation. However, in the operation of a closely held C corporation, which is typically what we're seeing, most of the time your accountant's going to strip out those profits, again, by paying yourself a salary and a bonus or distributing dividends to the shareholders, in this case, the retirement plan. So it's only on the sale where really that may arise. And again, that Rainmaker Advantage program eliminates that as well.
Okay. Another question here is, what percentage of the business can the 401k own? Can it own 1% or 100%? Does it matter?
So again, another good question. So it's important to understand this is not borrowing against your 401k. So it's not subject to that 50% or $50,000 maximum. So if you have, call it $400,000 in an IRA or a 401k or other plan, you can utilize 100% of your retirement plan to invest in a business. So you could utilize the entire $400,000, and the retirement plan can own 100% of that business. Having said that, we do recommend that at least $1,000 of personal investment, because should you wish to later get an SBA loan, they're going to require that $1,000 of personal investment in order to be able to guarantee the loan.
Cool. Another question here is, can you use this program to buy a going business that you own already?
You can, yes, you can utilize it to recapitalize an existing business. There would need to be an appraisal on that business. There's one thing that the government agencies are looking for, and that's something called adequate consideration, meaning they want to ensure that the retirement plan is purchasing shares in the company and getting a fair value. So they wouldn't want the retirement plan to invest 50% of the money and only get 10% of the company. But that is certainly a use for that. Although if it's an LLC or an S Corp, it would need to be converted to a C corporation in order to facilitate that.
And what does that require? Is that a taxation standpoint, or?
Well, it depends on the state, because some states do not have a provision for converting an LLC to a C corp. In those states, we would create the C corporation and have it by membership in the LLC. To mitigate taxes, in most cases, what we can do is we can exchange membership in the LLC for shares in a C corporation so that it doesn't reflect a sale. But that's working in conjunction with a CPA. However, you can revoke the S election, which is a tax election on an S corp, and have it become a C corporation. But both of those strategies need to be worked together with your accountant.
I gotcha. That was a good question. Here's another one. In a normal scenario, the C corp pays the taxes, or has to pay the 21% taxes, and then when they give a dividend to the individual, they have to pay taxes again. So it's like a double taxation. But if you're putting it into a Roth, if your Roth 401k owns it, you actually bypass the second taxation. Do you understand that?
That is correct. That is correct. Yeah. Great summation for that. So you would just pay the 21% corporate on the profits, and then it would go, the dividends would go into the Roth 401k. And when you pull it out, there would be no tax on that. And that, that speaks to one of the flexibilities of that second program, the Rainmaker Advantage program, that you can work with your CPA to decide which is most advantageous tax-wise. Should I take a salary or should I pay a dividend, since I'm the, a holder on the dividend? And depending on where your tax level is, you can balance those two to mitigate the overall tax implications from the business.
That's great. I don't see any other questions coming in there, but let me ask you this. What's the best way to get a hold of you? I see the screen up there says Tony Robinson. Is that the best way to get answers or follow up with this webinar?
Yes, Tony is the expert on both of these strategies, and his email is pretty simple to remember. It's tony@benetrends.com. So, and if he doesn't have the answer, we have 90 other people here at Benetrends who are all experts. But you can come to our website or reach directly out to Tony. He has both his direct number and cell. And Tony,
can you tell us what those are?
Sure. The direct number for Tony is 267-328-1316. Again, his direct line, 267-328-1316. And his cell is 267-273-4313. Again, 267-273-4313. Email is Tony@Benetrends, and that's BENETRENDS.com.
Thanks for that information. I'm sure there'll be a lot of people that'll be following up with you to get the particulars. Is there any charge for a consultation?
Consultations are free. We are not a hard sell here. As I say, both of these strategies, they're not a fit for everybody necessarily, but where they make sense, it's a great vehicle. So we take a consultative approach where let's explore, your funding options and see what makes sense. And if what we offer doesn't make sense, we may be able to direct you to somebody, that has a solution for you that ultimately will make better sense for you. We're all about helping entrepreneurs achieve success. So we want to make sure you get funded correctly, safely, and economically.
Okay, another question came in. Can you talk a little bit about the cost of setting these up and what we'd need to know about them?
Sure. So the first strategy, that Rob's program, Rollover for Business Startup, that's $49.95, just under $5,000. And we do the incorporation for you. We set up the retirement plan, all the provisions, provide you with the minute books, everything that you need for that custom designed retirement plan. And we also will administer that retirement plan. It's $145 a month, which is $1,740 a year. And for that, we do everything required for the retirement plan. Participant loan, we do the IRS 5500, the initial valuation for the plan in the beginning, second through 10-year business valuations, everything for the compliance of the plan. The second program, the Rainmaker Advantage program, a little bit more complicated. There's 2 levels of stock and dividends to keep track of. That's $59.95 and $175 a month. Okay,
and there isn't any other annual fee, just the 145 or 195 fee?
So the Rob's is $175 a month. I'm sorry, $145 a month, and the Advantage program is $175 a month, and that's all inclusive.
Okay, that seems like a pretty good deal with those examples. If you're anywhere close to those examples.
Yeah, we have a pretty efficient process in place, and so it makes us, due to our volume, more economical than typically you would find.
Sounds good to me. Again, Dallas, thank you very much for this information. If you could maybe tell us what some of the mistakes are that people have done when they've used this plan, and then some of the success stories, maybe.
Sure. I'll say the one mistake that we see sometimes when an individual will go to their accountant is more familiar many times with an LLC or an S Corp, so they try to convert the corporation to an S Corp or an LLC. And if you do that, that's a prohibited transaction, and then we have to jump through hoops with the government agencies to try to correct that. So that's really the biggest mistake that we see, is not recognizing that it has to be a C corporation. The other mistake that sometimes we see are they'll start other businesses under a different corporate umbrella, and there are control group issues that we need to be notified. So we try to be proactive. If you're making other investments in other businesses, we need to be notified to ensure compliance in both retirement plans, because they will be related in most instances. As far as success stories, there's probably too many to count in the 15,000 plus businesses we've done. But, we see, that example that I pulled with the $300,000 business selling for $1 million, that's a real case study example. It's not necessarily atypical. We did have a client who started a trampoline park and invested $1.2 million, and then 6 months later sold it for $3 million. We were all looking around for trampoline parks after that, but a lot of successes. And listen, it's nice to see. I'll say a significant portion of our clients are corporate refugees who are tired of the hamster wheel in corporate America and layoffs and wondering whether they're going to be next. And it's nice to see them go into business for themselves and leverage everything that they've learned in corporate America to build wealth for themselves instead of somebody else. So, we love hearing those positive stories, and you'll see a lot of those on our Google reviews. we have great Google reviews, and some of those stories will flesh that out for you as well.
Does it matter how many people are in the business or in the 401k?
No, in fact, that's thank you for bringing that up. You can use multiple retirement plans, so you can use a husband's IRA and a wife's 401k and a next door neighbor's IRA, just as long as they own the proportionate value. It does not matter.
Okay. All right. I thank you very much, and I look forward to meeting with you sometime this spring, and we'll catch lunch since we're not that far away. And if anybody has any questions, go to benetrends.com and get a hold of Tony Robinson, 267-328-1316, or his cell phone is 267-273-4313. Do you have anything else to part with us, Dallas?
Oh, well, thank you, Carl, for the opportunity to share what we do with some of your clients. And if anybody has any questions, give us a call. We've been doing it for 35 years. I'm sure we can figure something out.
All right. Thank you guys very much, and I appreciate the time.
Thank you. Take care, Carl.
You too.